Hello students, my name is Shesi George, your professional accounting teacher. In this video, we are going to consider the concept of work capital budgeting with working capital, okay? So this is the part 2 of the video. Please, if you have not watched the part 1, try to do that before you continue with this video. But before you continue, please, I will want you to subscribe to my YouTube channel, Georgian Theory Concepts. As you do that, thank you. All right, let's get started. In the last video, we discussed about capital budgeting, that is a project, okay? Now, if you want to embark on a project, you will need finance. So working capital, like I said, is a finance that is needed to finance the projects. For example, to buy raw materials, you will need cash to pay salary, to pay other running costs. All right. Now, how do you treat working capital when it comes to capital budgeting? Ordinarily, we know that our working capital is the difference between current assets and current liabilities. But as regards capital budgeting, working capital regards to cash that is needed to finance the project. All right, now let's look at this question. I want you to pause this video and read through this question number 1. If possible, please, I want you to write it down. The question says that calculate the net cash flow for each of the 3 years in question. For each of the years in question. Net cash flow is nothing but the difference between cash inflow, that is what comes into the project, and cash outflow, what goes out of the project in terms of cash. That is net cash flow. Okay, now we have machine costs 100,000. So this is first identified, that is cash outflow. The cost of machine is an outflow. In addition, a further 20,000 naira working capital is needed as an investor, as cash outflow, okay, and will be required to start the project. So let us go to our practice question 1. All right, you will write cash statement of cash flow. Okay, so we have year 0, that is now. Year 0 represents now. Then we have year 1, after you have invested. That's the year of investment, when the investment begins. Year 1, year 2, year 3, and 4. Why 4? Because the project is expected to last for 4 years. Look at, they said the project is expected to last for 4 years. All right, now you start with the cost of the project. That is cost, which is 100,000 in brackets. That is outflow, that is in bracket. Then they said working capital. So when you have working capital, the rule is that to invest your working capital as an outflow at the beginning of the year, the working capital you will need to run year 1 will be invested now. Then it will be recovered when the project, unless you are told otherwise, it will be recovered when the project ends. It will be recovered, so it will come as an inflow. It will come as an inflow, okay? It will be invested, that is outflow. Then the rule is that when you have working capital, it will be recovered at the end of the project. Don't forget that. Then you are told that and have a scrap value. So scrap value is the costs of the projects at the end of the year. It becomes an inflow. That is when the project is sold. That's the scrap value. So scrap value comes as an inflow at the end of the project. Then take note of this. They said net operating cash flows, okay, not cost. Net operating cash flows is to be 30,000 per annum. Is 30,000 per annum. Are you with me? For the first 2 years, okay. So we have net operating cash flows. All right. We start from year 1 as then to be positive, year 2 as an inflow, then 40,000. Can you see that? 40,000 the next 2 years, 40, then 40. Then you will add these two together. You add. So this one gives 120 in bracket. So this is the net cash flow. 120. This is 30. This is 30. This is 40,000. And of course, this is 80,000. This plus this plus this. Okay? So that is how to calculate net cash flow of the projects. All right. Before you now appraise the project. So go and watch my video on investment appraisal. Now let's quickly look at question number 2. Practice question number 2. Please take note of this. Now practice question number 2 says that a machine costs 15,000 and is expected to last for 4 years with a scrap value of 2,000 at the end of 4 years. So let us treat this first. So we have our statement of cash flow. Statements of cash flow. Okay. So we have year 0, year 1, year 2, year 3, and 4. All right. Okay, class. Now, the question says, if you look at the question, please, you can pause the video and write out this question. All right. Now, machine cost. So you have cost of the machine at year 0. Okay. That's the cost of the machine. All right. It will come as an outflow. Then it's expected to last for 4 years. That's why we have 4 here. Okay. Then with a scrap value of 2,000. Then the scrap value of what? 2,000. So scrap value comes as an inflow. Don't forget, at the end of the project. At the end of the project. All right. It comes at the end of the project. All right, class. Then we are told that sales revenue for first year. This is operating cost. Sales revenue is 5,000, 11,000, 8,000, and 9,000. So we have revenue. Year 1, 5,000. Okay, as you can see, 5,000. Year 2, 11,000. So year 2 is 11,000. Year 3, 8,000. Year 4 is 9,000. Then we have operating cost. Cost is what, class? Outflow. Cost is outflow. The cost is 2,000. So we have 2,000, 2,000, 2,000, all right, in brackets, and 2,000. Cost is an outflow because it's an expenditure. It goes out. That's the cost, operating cost. Now, we have working capital of 10,000 of the year revenue is required at the start of each year. At the start of each year. Take note of this. They said calculate the net cash flow. That is difference between inflow and outflow. Calculate the net cash flow. So working capital is 10%. Now let's start. Don't forget, working capital will be required now. That is year 0. The working capital for year 1 is 10%. We are told that it's 10% of year's revenue. And what is revenue? this is the revenue of, so the working capital that is needed in year 1 is 10%. So what is 10% of 5,000? And that is 500. Take note, that's 10 over 100 divided by times 10 divided by 100 times 5,000. All right, don't forget to be invested. Then for year 2 is 10% of the revenue, but must be ready before now. Are you with me now? Don't forget, we have already invested 500 and it has not been recovered. I told you in the first question, when working capital is invested in year 1, it will be recovered at the end of the project. That's what I told you at the beginning of this video in practice question 1, if you remember vividly very well. Okay, now this 500 has been invested and which will be required to be used for year 1 operation. Are you with me? For the year 1 operation. Now we need 10% of this, and 10% of this of 11,000 is over 1 times 10 all over 100. That is 1100. Okay, is what? 1100. That is 1,000. But we have already invested 500. So when you remove the 500 from this, what we need here is what? 600. So 600 plus this 500 that has been invested before, when you add these two together, okay, it will be 1100, which is 10% of the revenue. And when you add this, and that is what is needed for second year, don't forget. Now the working capital needed for year 3, according to the question, must always equal to the 10% of the revenue. According to this question, must always be 10% of the year revenue. And what we need in year 3 must have been invested in year 2. Okay, so we need how much, class? 800. That is 10% of 8,000. That is 10 over 100 times 8,000. Okay, but don't forget, we have already invested how much? 500, 600, which is 1100. It means when you remove 800, we need to recover 300. So that we'll remove our 300, then we are left with what? 800. We already have 500, 600. So we need to recover 300 so that we're left with 800, which will be usable in year 3. All right, class. Okay, so we are having 800 as working capital in the project. Okay, for year 4, what we needed in year 4 is 900, class. That is 10% of the revenue, but it must be invested now. Okay, already we have how much? We have 800. So what we needed is to invest just 100. We need to push in 100 so that we already have 800 before, don't forget, because out of the 1100 we recovered 300. We're having 800 before, so we need 100 to that 800 so that it will give us this 900. Then at the end of the project, the total money we have invested in working capital is 900 and it must be recovered, so it will be positive. All right, so you can replay the video if you don't understand, or you call me on my WhatsApp number. All right, okay, now let us calculate the net cash flow. Net cash flow therefore will be 15,500. Okay, this is 3,000. 500 minus 2, 3,000 minus this, that is 2. Okay, 3,000, that's 2,400. Okay, this is 11 minus 2, that's 900. 900 plus 3, that's 9,300. Okay, This is 800 minus 2, 600 minus 100. That's 600 minus that, 59. Okay, and here we have 200 plus 900 minus 2. That's 900 plus 900. That's 99. That's all. All right, class. This question number 2 is more technical than the question number 1. Please, if you love this video, kindly share with your friend, and don't forget to subscribe to my YouTube channel. Okay, subscribe to my YouTube channel. Bye for now. God bless you.